Hello, this is Steve Malone with CompuStuffX. I hope you're doing well today and you get some good trades. Today I want to simply answer a question that I've been asked by someone new to the Synergy trading model. Why do you use average price bars? Well, to answer that question, it's pretty simple. Keep out the noise and avoid false exits in the market. That's it. Avoid the noise, which means allowing me to stay the trend, and avoiding false exits. So what I want to do today in this video is to really pinpoint why I use the average price bars. Now, for those of y'all not familiar with the Synergy trading model, I continue to use it even though I developed it over 10 years ago and made it available to the public at no charge since 2006. If you've not ever seen the Synergy trading model, you can go to www.compusfx.com/synergy, simply register, and you can download it. The Synergy trading model is designed to compare price action to market sentiment. And when we have market sentiment and price action move in the same direction, we have a higher probable trade. And as you can see here, this tool down below known as the Trader's Dynamic Index, we already see that the green and the red line are starting to turn over and fade to the downside. Well, this has been moving slightly to the downside, and eventually now we have price starting to move to the downside. Now, there's no guarantee that price is going to continue moving to the downside, but it's the fact that as sentiment goes, oftentimes price goes. Now, up above in price action, we have a couple of tools here. We have the two yellow lines that represent the price action channel. This is synonymous with a tool used on Wall Street to really identify the trend of the market. Now, if I take these off, we really get down to the meat of the matter today, and that is the average price bars. And why do I use the average price bars, and what are these things? Well, the average price bars are somewhat similar to Heikin Ashi bars that you might find in MetaTrader and other platforms. It's been a bit modified so that price is averaged closer to the actual close in the marketplace. The original formula doesn't do that. So I've modified it to stay close to the current close, but not be so much like a fish out of water. And I mean, when you sit and you watch price, oftentimes that price is up and down, up and down, up and down. It's flipping around like a fish out of water. Well, that's not going to help me as a trader if I want consistency in my trading and I want to attempt to stay the trade. Let me show you bottom line what I'm getting at. Do you see that this has a nice move all the way up and it's blue all the way through? Well, let's take a look at what it looks like when you look at just the Japanese candlesticks. So I bring up just the Japanese candlesticks and notice that this move here, not so smooth anymore. Take a look at this. Do you notice that this right here, white? Do you notice here that we have a couple of whites? So there's a potential here that you could have exited here or exited at least up here because you got two white candles here suggesting maybe this is a top and it rolls down, whereas all of a sudden the market takes another push up for another potential 30 to 40 pips to the upside. Whereas when you take a look back at the average price bars, there's no red candle here or red candle here. And as a matter of fact, this guy goes all the way up and levels off pretty close to the top here. So what I'm getting at is the average price bars kept me in the trade longer and it helped me to avoid false exits. Now, this is not only found on just a 15-minute intraday chart. Take a look at this. Here's a 30-minute chart, and this actually happened today. Actually, a trader contacted me, and this is the reason why I'm doing this video, is he's saying, hey, Dean, you know, had I just followed the Japanese candlesticks, I had an exit right there, potentially, because it showed that it was possibly going to turn, and I would have possibly, taken off the trade or reduced my position. So that was about 2,000 hours. Go take a look at the average price bars here. Look at that. It still remains red and runs all the way down, and we finally get an exit scenario back over here right around 2230. Go back over here. Where's 2230? It's right there with that big bar to the upside. But yet, there's no false exit. We're able to hold in there and stay the trade. Now, this is great for those of y'all who trade price action. If you're really following price action and you want that trend continuation, you want to stay with the trend and cut out all the noise, the average price bars help you do that. Let's take you one more look at something here. Take a look at the 4-hour chart of the Euro Yen. The Euro Yen's had a pretty nice move up from 136.65 area all the way back up to 140. That's a pretty sweet little move to the upside. But it did have some potential exits. Here's one. There's one. Here's one right over here. Okay, let's go take a look. That's at 8 o'clock right there. And this one here looks to be at, let me move this one out of the way. Let's just take a look at this one right here. At 0-100 hours, on February the 7th, let's go take a look what it looked like. There it is, right there. That did not change to a red candle, and you could have stayed in the trade all the way up. And then eventually, right where we had that exit over there at 8 o'clock on the 10th, we get a red bar there suggesting a potential exit. Now, there's more rules that could be applied. It's outside the price action channel, potential continuation. Those who trade the Synergy trading model know what to look for here, and they could have potentially traded to the upside. So long story short, as you trade and you want to avoid, like the situation here, of an early exit, you want to stay the trade. I mean, look at this guy. Just from the low to this potential low here, there's another potential 20 pips in the marketplace. Now, I don't know about you, but 20 pips, it means something to me. And so if I can trade in a way to where I'm not shaken out of the market and I'm able to stay in the market as far as it could potentially go and get some more pips in my pocket potentially, I want to do that. So I'll tell you what, if you're considering price action as you trade and you want to look for something that might help you stay in the trade longer, consider the Synergy average price bars. Again, go over to the Compass FX website, go to www.compassfx.com/synergy, register, and you can download it for free. Well, this is Dean Malone with Compass FX. I hope some of the information here has helped you in your trading. Y'all make it a great day. Get some good trades. We'll talk to you next time. Bye-bye.